I studied volume to death. I love volume. But Bill has taught us that you need to always be doing original research, always have an open mind. And just like back in the day when, in the early days of his work, when he did the first model book studies, he determined that, PEs, as much as the entire industry was really built around the price to earnings ratios, lower being better, the data just told him that it wasn't relevant. If you skipped the stocks with the highest PEs, you missed almost all of the biggest winners. And so he went out on a limb and said, hey, PEs don't matter. And he got a lot of backlash. And so that's kind of the similar thing that I'm doing with volume, is I'm just being objective with it. And it's not that I don't think it's important. It's extremely important. I just don't think that we have an accurate measure of volume anymore. I think that the volume is dirty, and we're going to get into why. But just for the newer people to understand what volume means, volume confirms price action. Mm-hmm. So if you have a good measurement of volume, what it does is it tells you that, hey, this price action is for real. If you had a move up with no volume, that's kind of like a sucker type of move. It's not, you don't really have demand in there. But if it goes along with volume on the upside, then it's telling you that there's conviction in there and there's a lot of demand. So it's really a measurement of demand. Now, things have changed, in my opinion, and it's slow. And I really hate to use this analogy, but all the little pieces, the mosaic of it, it really kind of feels like that terrible example of the frog in the boiling water, where it's there, the water is cold, he's fine, and it slowly gets up and it doesn't jump out. Now, Justin told me that's not true. Frogs will jump out. With me as an animal lover, as a vegetarian, it made me feel better about telling this story that frogs will jump out. So I'm jumping out of this pot because I've had enough information about volume. So really where it started from is I started looking at the different times when volume just didn't act right. And, I was trying to think, where did all of my thoughts on volume not being clean come from? And one of the earliest discussions I had with Bill was, he called me up. I don't remember the stock, but we were both trading the stock and it was going through a pivot area. And he's like, Mike, he calls me up, Mike, pull up XYZ. What do you see? I'm like, I didn't know where he's going. He's like, look at the volume rate. It's only 40, and we like 50 or higher on a pivot. In fact, much higher. And he's like, they've figured it out. They know to not let that volume rate get higher. It's playing possum. So if you ever hear me say like the Bill Possum story, that's where it started, where he said, okay, one, the market is starting to figure out that they don't want to push a stock up because they know that there are people who look for big volume. So they have smarter ways of doing things, and they can,
or maybe the technology got a little bit better, the mechanics got a little bit better, so they could hide their
exactly. They could hide their orders, they could use dark pools and all sorts of ways. So that's where it started. And then fast forward a number of years, I was building a couple of algos at O'Neill, and I was spending a lot of time. And an algo is just basically a program that says, if this happens, then you do this. And so I built this one based off of the pattern rec, and it's like, okay, if it broke out of a certain type of base in a certain way, then buy it. And one of the constraints was volume. And I looked at it and I was saying, okay, what information do you know at that time? And when you're looking historically, you don't know at what time during the day that volume came through. So I started really, looking at it closely. And then that's where this whole kind of epiphany came from of all of the volume stuff. It was really going through, thousands of hours of going through back tests, not just my back tests, but the other algo developers. I really got into it. It was so much fun. And I would look at all of their trades, all their back tests to learn. And they all did a great job. And it was so much fun. And so anyways, it got me really into a clean data mindset, because in my back test, I'd go back to 1963. and 63 to that was about 2015 at the time. And what I found is if you don't have clean data, your back test is meaningless. So I tried to make all the data as clean as possible. So then I ended up really discounting volume, but at the time I still thought volume was still clean. But it was more of a timing issue of what do you know at the time. Then I started putting all these pieces together of looking at stocks that were breaking out without significant volume, which was odd because I had done a study in 2013 of every base, not some of them, but every base breakout from 2013 or 1963 to 2013. Every base using pattern rec to measure every last item in there. And the two most important items were relative strength, the number, the higher the better, gave you the best performance, and then the biggest volume rate on a breakout. And so I knew the volume historically was the most important thing on the breakout. So it's not that I'm anti-volume, it's just that we're going to get into it now. I just wanted to set that up, that I think volume is dirty. So have an open mind with this. I'm not a volume hater, I'm a volume lover, Okay. So what you want to do is think through how the mechanics have changed. Put yourself back in the mindset of like trading when Bill started in the 50s and late 50s and early 60s. He would call up his broker, and then what he would do is then the broker would then have a connection to the floor, the New York Stock Exchange mainly. Then that person would take that information, then he or she would walk over to the booth. Then at that point, then they would talk to the specialist, find out the offer, the bid, the ask, they work something out, then that would get related back. And there was heavy commissions involved. So if you were making a trade, you were making a big commitment because you had a big commissions, even on the institutional side, it was a nickel a share, and that adds up. So you weren't just doing what you're doing now where someone's just on their phone, trading for free, and they buy something, it doesn't work out, a second later they're selling. It was a real commitment because you had a big commission hit, you had slippage, things weren't traded in decimals, you had big spreads, and they were in fractions back then. And so the volume really meant something because that was true actual demand of someone who was in there and they wanted to buy it or they wanted to sell it. So it happened on the reverse. Something's breaking the 50-day, just get me out, market order. Bill would always do market orders, just get me out. Of course, the trading desk would work that order, but he was getting out as quickly as possible. So that was your conviction. Now, all these little things have changed. Now you have 1 million ETFs, you have high frequency trading, you have algos, not just the algo that I built, but algos that are intraday algos that are trying to just get in between the spread and just go, okay, this thing is offered at $100 and the bid is $99.10. They're trying to go in it, even fractions of a penny. They're just trying to get inside of it. That's not true conviction. That's just order flow, right? They're trying to just make tiny little pennies here that add up to big dollars. You saw it with all of the people are trying to move the data, their data as close to the end source as possible to get little milliseconds, because all of that adds up, translates not to millions but billions of dollars. So
yeah, just watch Richard Pryor in Superman 3, was it?
Yeah.
Yeah, right.
You
don't have to get a full penny, but all that rounding.
Yeah, exactly. So think through all the mechanics. And as you sit and think of what's different historically than now, you'll start thinking, oh, wow. And then now we've got, with the stocks, you can trade a 1.5 levered stock on things. You can trade, daily options. Originally it was just quarterly options and monthly options, weekly. Now you've got single day options. And then the option market changes the mechanics of the stock prices as well, and the volume flow, because you have the market makers that they're trying to neutralize their end of things. And so they're in there buying stuff when it's really not demand. It's they're either buying or selling to try to neutralize their risk, to do their risk management. You also, the ETFs are a big part of this too, of dirty volume, where if you're a big fund manager, like not a medium size, but a big fund manager, and you want exposure, you can go in there and buy the Qs, let's say, or the spiders, or a bunch of other ones that are big and liquid. And then that's going to translate into the volume of the stock that you're looking at, any of the ones that are in there. So when you start adding up all of these things, and I could, I was going to list give you a list of like 50 different things, but I didn't want to bore people.
But so, Mike, what about like, so that's happening every day for the most part. But what about like unusual volume? Like on a relative basis, it's much more than kind of the normal trades. How do you look at that?
Well, so what you want to think of is when there's an unusual move in a stock, right? Algos are jumping in there, right? And you've got the high frequency traders because it's active. They don't want to trade in the dead ones, the ones that aren't doing anything. So if you get a spike up, let's say something's moving in pre-market, those are going to be, all the day traders or even the smaller hedge funds that are doing that. They're in there because just that's where it's active. It's like, what's active today? Where's the pre-market volume? And then what's moving the most during the normal hours. So you're going to have these spikes that are magnified. Now, the problem why I call it dirty is there's no way for me to be able to quantify and say, okay, well, 5% of it is for algos, 5% of it is for ETFs, 5% of it is for these leverage products, another 7% is for options related, another 3% is because everyone's trading for free now, and so on and so forth. All these little things add up, and I just have not figured out a way, and I don't think there is a way to determine what was the traditional conviction. Volume is conviction, right? What is that? Like, what is that figure? So if something, we like to do a volume rate measurement. That's something that Bill came up with a long time ago. That says, okay, if it normally trades 1 million shares on any day, and we look back 50 days, then if it's trading 1 million shares, nothing normal is everything's normal. Nothing unusual is happening. But if it trades 2 million shares, now something big is happening. That's a huge volume rate on there. So that difference between normal and abnormal, which we're always looking at in every which way, you don't know how much of that is true. I want XYZ stock. I'm a big fund manager. I've got $100 million to put to work in, let's say, Apple. How much of that $100 million that they're putting in there today is really translates into the tape? How much is that magnified by all the people that are jumping in front of that order flow, see that big whale in there, or the elephant jumping into the bathtub, the way Bill used to say? How much is it magnified? I don't know. And so when I don't know something for certain, I stop looking at it. And so I've stopped looking at volume completely until I can get a handle on this. I want it. It's like I've lost an edge, because volume is so important. So I'm not saying volume isn't important or any ways of measuring volume. There's a million different ways that we used to slice it, but it's just different now. And I don't expect anyone to go, oh, well, Webby said that, so I'm going to, agree with it. Think about it. Just spend some time with an open mind and think through and go, okay, 1 million shares traded in XYZ today. How many of those shares were really someone wanting in and someone wanting out? And how much of that was just market mechanics changing? Making things as simple as possible is what Bill was about. Even though lots of times you'll look at his stuff and it seems complex, but he really did a great job at making things as simple as possible. So it helps. And I have volume off on a lot of my charts. Wherever, whatever service I'm using, if it allows me to turn volume off, I just turn it off. So it's.
So you just have price and relative strength, or What do you have?
I have a lot of indicators that I've built, like the Webby RSI and ATR related things and moving averages, but they're all based off of price. When I build something, when I use something, I try to build it something that I'm visually trying to see. You know, like okay, a stock is getting tighter, so then I want to see, okay, how can I measure tightness? And then I'll build something around it and use that. But I don't use things that are pointing to other things other than price. So it's all price related. So in relative strength is price related, right? Because it's the price of your stock or ETF versus your benchmark, which we use the spiders for, the S&P 500. So I just use clean data. You know what the open is, you know what the close is, you know what the high and the low is. Like that's clean data. You can't get any cleaner than that.